Well, a new report showing higher than expected inflation caused the stock market yesterday to have its worst day in more than 2 years. The S&P 500 falling more than 4%. Oh, here to break down what this all means.
Today was more fun, though. Today was more fun. We had a little bit of a kickback.
Mike Giordano with Williams Wealth Management. Help us out here. Okay, so that report showed inflation still hasn't slowed as much as expected. Can you explain to us exactly what spooked the markets?
Expectations. Exactly what you just said. Yeah, it's kind of like when I go to an Italian restaurant and I get spaghetti meatballs and they give me one meatball.
Oh.
It's not bad, but I wanted 2 meatballs.
Yeah.
So it's kind of like the same thing. The market was expecting inflation to come off more than it did. It didn't. Everyone was positioning that we were going to see inflation coming off because remember, we've been seeing gas prices coming in for 3+ months. I just got gas the other day for under $3. So, you know, when you saw the gas prices continue to plummet, other commodity prices, the expectation was, man, inflation's really going to come in. It came in a little bit, but it didn't come in as much. And then worse yet, you saw housing inflation continue to keep surging. Okay,
so looking ahead, should we be expecting more of these intense sell-offs in the coming weeks and months?
Yeah, I would say expect the craziness to continue here because inflation and the Federal Reserve kind of go hand in hand. So the higher inflation is, the more the Federal Reserve has to keep hiking rates. If we can see that reversed, then they can start cutting rates, or at least maybe not having to hike as much. That's what the market was set up for yesterday. They thought, man, we're going to see the Federal Reserve not have to cut much more. Obviously, after yesterday's report, they're going to have to continue cutting, and so that's the situation we're going to be playing over the next couple of months.
So, of course, a lot of people asking you this question: what's the big takeaway for me? How should we be thinking about our investments? Should we stay the course, make adjustments?
You need to think long term, and you need to think from like airplane 30,000-foot view. If you're putting money to work for the next 2 or 3 months, yeah, you never want to put that money in the stock market, whether it's these kinds of volatile markets or even, you know, if we're at all-time highs. But if you've been putting money to work and you put money to work back in, you know, January, you're buying stuff now at 18% off of those prices in some cases if you're buying the S&P 500. And so just continue sticking with your strategy. So the monies that you need in the next few years, those should never be in the market, but the monies that you need 5 years out, the market's a good place.
All right, great advice. Mike Giordano with Williams Wealth Management. We'll see you
I'm going to bring the clipboard next time because I like Griffin's clipboard.
Griffin looked very prepared with his clipboard.
I would have looked better with a clipboard, I'm telling you.
We'll look for that next week. Thank you, Mike. We'll be right back.